Good afternoon and welcome, ladies and gentlemen, to the Wednesday Lunchtime Drive-Thru on this Wednesday, July the 14th, 2021. And I'm your host, Damon King, Certified Financial Planner Professional and Wealth Management Specialist with ChappelWood Financial Services. I'm also the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. And we always want to bring to you the latest and greatest news, hot off the press, what's going on with the market, the economy, and really anything related to the world of finance. And today, I am extremely honored and proud to introduce to you my friend, my colleague, and a great resource to us here at ChappelWood Financial and to our clients, Karen Ibay. So Karen, welcome to the Wednesday.
Thanks so much for letting me join you today.
Absolutely. Here's a little bit about Karen. She is a vice president with J.P. Morgan Asset Management, one of the biggest names in the world of finance. She's a client advisor to financial advisors serving high net worth households. So much like I am the advisor to you as the client, Karen is the advisor to us as the financial advisor. So she is providing, particularly for our clients who have J.P. Morgan as one of their investment strategists, she is our primary contact whenever we are getting research information about what's going on in the market. She previously served as an internal client advisor for J.P. Morgan in New York City, so she's had some time up on Wall Street. She's got 22 years of industry experience, so this woman knows what she's talking about. You would be well served to listen to her. So, Karen, with that, I am going to relinquish control of the presentation today to you, because I know you've got some information that you want to share. And while we're doing that, ladies and gentlemen, we are going to have some Q&A in the second half of today's presentation. So go ahead, submit your questions via the Q&A or chat functions. But here in this first half, I'm going to let Karen have the floor, and then we'll get to your questions here in just a little bit. So, Karen, I am going to stop sharing my screen here. I'm going to make you the host right now. So you should be able to share your slides on the screen.
Okay, well, good afternoon, everybody. And thank you again, Damon and the team at ChappelWood for letting me join you on your quick Wednesday drive-through. What a great idea to be able to just kind of hit the highlights from important financial topics that are on the minds of investors. And today, my goal is just to give you a brief market update about where J.P. Morgan thinks that the markets are headed. And things that we're watching. You know, the longer that we're in this business, the more we realize that there's always something on the horizon. There's always some reason to be cautious, but our goal is to make sure that we're making the best decisions that we can, given the current information that we have. We don't have a crystal ball. We don't know exactly what's going to happen, but our goal is to really digest everything that we currently know and simply make the best decisions for us and for our families. So today I pulled together a couple of slides from our signature research piece called The Guide to the Markets. This is published on a daily basis. This data is as of Monday's market close for us today, but it really is a fantastic resource if you're looking for the most up-to-date, unbiased information when it comes to where the market is and where we think the market is heading. And I won't bury the headlines for you. We've only got a short 30 minutes together this afternoon. But the view from J.P. Morgan is quite optimistic, and it really starts with the idea that the economy is continuing to rebound and do so dramatically. And so what you're looking at on this slide here is economic growth and the composition of GDP. So on the left-hand side, we're looking at what has happened to growth of the economy over the course of the last couple of years, and no shock, we can see the dramatic drawdown to the economic recession that we had last year. But since, you know, the second and into the third quarters of last year, the economy has just been on a roaring tear, and it's been exciting to see and exciting to watch, especially if you've been invested. You know, the economy is a backward-looking indicator, and the market is more of a forward-looking indicator. But we always look at economic growth because we want to see, you know, if we can anticipate stronger growth going forward. And the great news at J.P. Morgan is that we believe the economy is going to grow somewhere between 6 and 7% this year. We haven't seen that kind of economic growth since the early 80s. I think back, you'll have to fact check me, Damon, but I think in 1984 was the last time we saw the economy growing that much.
Yeah,
So
and I think the important thing to take away from that is that basically represents triple what we normally see in a given year. Right?
Exactly. Triple the average economic growth that we have. And on the right-hand side of this chart, this is really the fundamental. You don't need to break out your economic textbook from college. The fundamental driver of our economy here in the United States is consumption. Close to 70% of our economy is driven by consumption. And so even if you don't really enjoy talking about economics the way that Damon and I do, or follow it that closely, if you just look at the world around us, you can see that people are consuming. Now, we'll get into it in a moment here, what that means in terms of inflation and some of the other more sticky pain points that we have when an economy is growing this quickly. But at the end of the day, when the consumer is consuming, the economy is going to grow. And we expect that that is going to be extraordinary over the course of the rest of 2021 and into 2022. And that's a great foundation for our conversation today. Now, as we translate to more forward-looking indicators, one of the broadest overall measures of the stock market is the U.S. stock market. And for purposes of this data, we're just looking at the S&P 500, and we look at it in terms of annual returns and intra-year declines. So the way you read this chart is anything above that horizontal line there means that the U.S. stock market, when measured by the S&P 500, was positive that year. Anything below that horizontal line, the stock market was negative. And then the red dots below the lines, the bars, represent the drawdown that we saw that year. So Damon mentioned I've been in the industry a long time, 22 years. When I saw this chart for the first time, and I had already been in the industry probably 10, 12 years at that point, this blew my mind because it showed me a couple of key tenets when it comes to investing. First one is, more often than not, the stock market goes up. That's great. That's great news for investors, but it's hard to remember it when we feel like the market is just going up and down or sideways, like Damon was talking about before. It feels like there's no whim to what's happening. But the good news is that when you look at the data tells us that more often than not, the stock market goes up. The other thing that blew my mind when I saw this chart for the first time was that every single year, we have some sort of market pullback. Now, sometimes it's a big pullback like last year. You can see the second bar from the right here, this down 34%. That was March of last year. We had a massive drawdown due to the global pandemic. But you see the market recovered incredibly strong, ended up the year 16%. So far this year, and remind you, it's only the middle of July, the market's already up 17%. Now, we've already had a pullback to the tune of about 4%. You may have noticed it, you may not have, just given the fact that it's relatively small when you compare it to what we experienced last year. But the takeaway that I had from this slide is that every single year there's volatility. Doesn't matter if it's, sometimes it's larger, sometimes it's smaller, but every single year we will have some sort of pullback. So when we know those things that we've already discussed so far, that the economy is going to grow rapidly, the market is positive more often than it's not, and every single year we have volatility, that's a great foundation for setting yourself up to be a successful investor. And so one of the reasons that we are pretty optimistic about the future of the market, not to mean that we won't have sell-offs, but just meaning that we expect the markets to continue to do well, is simply because of the foundation, the fundamentals is often the word that you hear in our industry, look so strong. This is a brand new slide in the third quarter guide to the markets that was just released at the beginning of July. And you can see on the left-hand side, we're looking at S&P 500 earnings per share. And the blue bars represent consensus analyst estimates. You might have noticed that we're starting to get second quarter company profits are being released and earnings are being released. And really the outlook is just extraordinary. We expect that companies, speaking very broadly, are going to make more money than they ever have, even more than 2019. And again, it comes back to that consumer. It comes back to a recovering economy where we expect that the markets are going to continue to drive based on fundamental principle that companies produce goods and services that people want to buy, and we as shareholders get to share in those future profits. So again, go ahead, Damon.
I was going to say, this slide right here really highlights what we were talking about at the beginning of the year and the video that we sent out last week, that, you know, we had all of the optimism and the hope over the vaccine eradicating the virus, and that we expected the market and economic growth to just take off in the first quarter of this year. But then after that wears away, it starts to set in that, holy cow, you know, we're going to have all this inflation, and are we really making progress? And that we would see a flattening out of the curve in the second quarter, which is what we've seen. You know, of that 17% return that we've had so far in the S&P 500, more than 10% of that came in the first quarter. But from April through June, what was it up? About 5%, something like that.
Yeah.
But then we do expect it to kind of go back up and end the year strong, because of exactly what you're showing here, that eventually we believe that the consumption and the joy of being able to get out and spend some money will overcome a lot of the uncertainty and fear over inflation and the other downward pressures that we're seeing.
That's exactly right. That's exactly right. So I'll kind of move forward here and try to keep my comments brief, because I want to get to your questions. I can get super excited about this and start chatting. But let's talk about.
We're nerds, aren't we? We're just geeks. That's just the way
we are. We are self-proclaimed market nerds. So we love talking about this stuff. And one of the biggest questions that I've been fielding from investors has been, what do we expect about inflation? Now, this chart's a little busy, and it takes you a moment to kind of digest it here. But we're looking at long-run inflation expectations using 3 different measurements. One, we look at consumer expectations, which is measured by a survey coming out of Michigan that just simply asks people the question, what % per year do you expect prices to go up? That's that light blue line. But then we've also got professional forecasters, which is your dark blue line. And then we've got your 5-year forward-looking inflation expectations as measured by the Federal Reserve. Now you'll notice that certainly consumers expect inflation to become, to grow and be higher and be more relevant in terms of their overall day-to-day spending. But the point of this slide is that really on no accounts are we seeing inflation expectations for the next 10 years to be anywhere close to 4 to 5%, which is some of the numbers that you've heard here recently as we talk about quarter over quarter inflation growth and year over year inflation growth. This is a byproduct of the recession that we went through. But you know, I've had this conversation with Damon last time I was in the office chatting with him about it. This is an area where we feel like it's really critical that investors get it right, and that you work with your team very, very closely to make sure you're taking on the proper amount of risk, but not taking undue risk, right? And what I mean by that in the final slide that I'll share with you here is just, we see a tremendous amount of investors choosing to keep cash on the sidelines. Now, this is one measurement of how we look at it. Over here to the right-hand side, we see savings deposits at an all-time high of $11.3 trillion. We break that down into retail money market mutual funds and other different accounts within 401ks and retirement accounts. But the point of this slide is there's records amounts of cash on the sidelines. And with inflation where it is, not that we expect that it's going to be alarming for, you know, your retirement planning perspective, we do recognize that you simply do have to keep pace with inflation, and cash is not going to get you there. Damon, anything that you wanted to add to that?
No, I agree completely. You know, we're advocates, obviously, of having cash in the bank and cash available. It's part of your gold buckets, and all of our clients on the call today have the gold buckets. You've seen your gold buckets. You know you've got some cash in the bank. But there comes a time when you might have too much cash, either in the bank or sitting inside of your investment accounts. And yeah, right now, cash is doing nothing for you. So it comes down to, what's that balance? How much cash will make you feel comfortable? And perhaps we could put more of that to work so that we have a little bit more balance than certainly $11 trillion sitting in, or $1 billion sitting in, well, no, it is trillion, right? $11 trillion sitting in cash.
That's right. That's right. And I'll end it with this comment and then we can open it up for your questions. But this is the number one reason why I believe that we are not going to experience an extended drawdown, right? So we know the market goes up, the market goes down. We saw that on the data slides earlier. But with this much cash on the sidelines, essentially earning nothing, the likelihood that the market goes down and stays down to where you would have the luxury to wait a quarter or 6 months or a year before you feel comfortable investing, it's not going to happen. This money will go looking for return the moment that we do get those pullbacks. And that's a big change even since 2008. The market moves incredibly quickly. And that's why the plan that you build with your team at ChappelWood is really designed to help you navigate that volatility so that you don't have to jump in and jump out, because that's a recipe for a very challenging environment for investors to try to get right.
Yeah. Well, and either that or there's that. And my recommendation would be, and we have some of our clients on the call today, that we have this baked into their portfolio already, that there is more of a tactical approach, that some of their money is, we're going to ride the waves, whatever comes, we'll make adjustments as needed. But there's some of their money that is on a daily basis. As volatility goes up, exposure to the stock market comes down, and that means cash goes up. So if you're concerned about some of these daily movements, then maybe building in some of that more nimble money that really moves with the market on a daily basis sometimes, that's preferable in my opinion than trying to bounce in and out of the market and trying to guess when those times are going to be.
Yes, absolutely. Well, I'll go ahead and stop sharing and make you host again.
All right, perfect. Okay, so now, ladies and gentlemen, let me come back to our slides here. Now I'd like to welcome your questions. So what questions or thoughts do you all have for Karen? We've got about 12 minutes. That's plenty of time to get some really good questions in. We've got a lot of people on the call today. So fire away. Use the Q&A button or the chat function. I will monitor the questions as they come in and toss them to Karen. Karen, just to kind of get the ball rolling here until the first question comes in. So we expect economic growth to be 6 to 7% by the end of the year. Right now, the S&P 500 is up about 17% for the year. Does J.P. Morgan have a projection for where we think the market will end in terms of up from where it is now, or will it go down? What do we expect by the end of the year, the third and fourth quarter to look like?
Yeah, it's a great question, and that really is the $1 million question, or maybe multi-million.
That's why I asked it. We have $1 million clients.
Right. So, it's tough to put an actual percentage of additional return that we think can be created. But when you kind of factor in those earnings projections, then we can know that, yes, there's still several percentage points that we could move higher. But here's the challenge is when you take the market as a whole, some parts of the market are really, really expensive. And some parts of the market still have a lot of value to them. And that's what your strategists that you work with, like those at J.P. Morgan and other wonderful strategists that you have available to your clients at ChappelWood, that's their job. These professional money managers are coming in here and figuring out which are the companies that have the ability to outperform not only in this market environment, but for years to come, decades to come. And so there really is an opportunity, even if we don't see a tremendous, the view from J.P. Morgan is not, we're going to see another 17% return in the second half of the year. Is it possible? Yes, it's always possible. But kind of given the massive amount of growth that we've seen, probably not likely. Right. But that does not mean that your investments are not going to continue to grow because of the professional money management that you have wrapped up into it. So
in many ways, we've already kind of gotten our shot of adrenaline for the year. And
that's right.
that came in the first quarter. So we do have a good question here from Mary Sue. She asks, are there any particular segments of the marketplace that you see particularly good growth opportunities? Anything that J.P. Morgan is specifically tracking or just in general?
Great question. So, There's been kind of a tale of two markets so far. Up until throughout the pandemic, you saw high growth stocks do extraordinarily well. Anything technology related, online retail, just extraordinary growth because of the nature of the recession that we went through. Then comes sort of the beginning of November, right after an announcement around the vaccine and mass distribution plans. We saw a rotation more towards what we call value stocks, stocks that are underappreciated by the market. And part of it has been deeper value, meaning things that were really beat up during 2020. Those names are typically led by two big categories, financials and energy. So we're here in Oklahoma. Maybe a lot of you on this drive-through today are as well. We would love to cheer on higher energy prices. I'm kind of surprised to see them north of $70 right now. That's a great win for us and for the state. But there's an opportunity, particularly within financials. So most people think that you need to have higher interest rates simply for financials, meaning banks and insurance companies and all these different parts of the financial industry to do well. But I would also argue that banks had to really get prepared last year for potential loan losses. So they had to keep a lot of cash on their balance sheets. And as these bank stocks are starting to report this week, we're starting to see that they're able to release some of those loan loss reserves. That will be available for share buybacks, for dividend growth. So there's still a lot of opportunity in some of these value names that tend to do well when the economy heats up. Now, will value outperform growth? That's kind of anybody's call. Growth is one of those parts of the market that tends to do well when we're in a slow growth environment. And Damon talked about that return to 2 to 2.5% growth, which is kind of consistently where we see it. So I would, the official call from J.P. Morgan is you want to own both growth and value. But I certainly think there's still opportunity, particularly in some of these sectors like financials that have been beat down pretty significantly over the course of the last year and are just now getting back to being profitable again.
And I think probably another area, Mary Sue, that a lot of people are looking at, and Karen, tell me what you think about this. But as we go into the end of the year, other industries that were beaten up related to the travel and entertainment industry, airlines. Now, right now, I think about our strategists. We really don't have much exposure to airlines and cruise lines and hotels yet. It's still sort of in that transitional phase from what we can tell. But as we get further into the year and people really start to travel, we could see some of those big names, the airlines, the hotels, the casinos, the cruise lines, all of that come back into play. What does J.P. Morgan think about that?
Yeah, I think that's a great area to be mindful of because it's all driven by consumption, right? We talked about that consumer story of people feeling better about, their jobs aren't going to necessarily be lost and the pandemic is at some point going to reach either a level of normalcy or be under control. And so that's going to be driven by consumption. And we certainly see the silver lining right now in terms of people getting out and spending, and certainly travel will be a big component of that, 100%.
Ladies and gentlemen, we have empty phone lines, as they say on the radio. Please submit your questions if you've got some questions right now. We still have about 5 minutes or so. So you've got free reign. If you've got a question, send it in right now. We've got Karen here for about the next 5 minutes. I will, let's see, do we have any questions here? Okay, I want to make sure that I didn't miss anything. So if you've got a question for Karen, please submit it through the Q&A or the chat function. Karen, what do you guys think about interest rates? So Fed Chairman Powell spoke today. Actually, I'm not even sure if he's spoken yet, but in his remarks, he's basically going to say that, yes, inflation is high right now relative to last year and probably will be for the next year or so, but then we should see a leveling off. And you addressed inflation earlier. Do you believe then, or does J.P. Morgan believe that because they see inflation kind of leveling off, that really means they're going to stick to their guns and keep interest rates low, at least through the next year or so?
Yeah, that is the the view from J.P. Morgan that interest rates are still going to stay low for a significantly longer period of time, which is why I pound the table on cash so much as being, you need it for, everybody needs a certain level of cash, but as an investment, maybe driven by fear that the market might go down or whatever the case may be, we think that interest rates are going to continue to not only stay low for the next year, but be significantly lower than what we've seen in the past for a very long time into the future. And so, we're not necessarily concerned that you're going to see higher interest rates immediately. That's, in our view, a couple of years off. But the one thing I would remind all investors is that the path to higher interest rates is paved with growth. And so one of the best things that you can do is be positioning or thinking about your overall investments with a growth mindset. And that's one area that will help to make the pain of rising interest rates not as painful as it will be.
Yeah. And going back to inflation, one thing that I'll remind certainly, oh, wait. We've got a question here. Ron. Hey, Ron, good to see you. Ron has a question. Very simple question, but a very big one. What is your biggest market worry?
Oh, my biggest market worry. So I got a list of 5 of them that I kind of keep on my desk here and I kind of watch them daily, but I'll just give you one of the biggest ones that I see is that we have difficulty getting labor back to work. Because if there's all these people out with money to buy and people wanting to buy, and we know that consumption drives everything. But if we can't get workers to come back to work for whatever reason that might be, that could potentially slow down these corporate earnings. And so my biggest worry is really around that corporate earnings picture. What if that doesn't materialize? Because that, I think, could be one of the biggest things that could cause a market pullback is that these expectations are really high. And if we can't get workers back to work in the restaurants, on the airlines, producing the goods and services that people want to buy, even if you have willing buyers, you can't get the product out the door. So I think that's a really big concern. And I think there's steps in place right now to try to work towards that. I know the enhanced unemployment benefits are going to start to be pulled back. And so, I think that will continue to drive people into the labor force, but that's my biggest worry.
Yeah. Well, and that labor shortage has implications for inflation because yes, inflation is high right now because demand is high, but supply is low. Well, when you think about supply includes services, and 2/3 of all consumer spending, which Karen is saying consumer spending drives the economy. 2/3 of consumer spending is on services, not goods and products. Services require people to provide. And so that has implications for if you go down to your local restaurant, they don't have as many servers, many people waiting tables. They can't get food out as quickly. Their profits are not as much, so they may consider increasing their prices. Labor shortages lead to inflation because of the inability to deliver services in as timely a fashion. All of this stuff is interconnected. So, if you know someone who's looking for a job, they're out there. They're out there to be had. So anyway. We do have another question that came in here. This is a great question. Dan asks, any concerns about futures legislation, for example, taxes and regulations or proposed government programs? So what say you, Karen?
Yeah, good question, Dan. And I was thinking about adding a slide in to talk about taxes, and then I'm like, oh, do I open that can of worms or not? But you opened it for me, Dan, so I'll share with you.
We'll blame it on Dan. He opened it.
That's right, Dan. Sorry, everybody else on the line. It's Dan's fault. But certainly, it does appear that we will be facing higher taxes down the road. Because when you think about all the stimulus is not free, right? It's got to come from somewhere. And right now it's come in the form of increasing federal debt. Now, we're not to the point in our view at J.P. Morgan that federal debt is going to cripple the United States economy. But we recognize that at some point it has to be dealt with. And there's really only 3 ways you get out of it. Either you grow your way out, which both Damon and I agree, 2% regular trend growth is not going to be the way that you grow yourself out of the amount of debt that we have. You inflate your way out, which, as we've been talking about, is really, really risky. And third way is you pay your way out. And that's in the form of higher taxes. And so I certainly think that that is down the road. Now, I don't think it's imminent because there's just not enough bipartisanship right now to get a huge tax package passed. But I do think, it is wise as an investor to be preparing with Damon and your team at ChappelWood for higher taxes. And the great news is that they're the experts when it comes to tax-advantaged investing and tax-free transfer of wealth. So you're in really good hands. My fear is for the folks who are not working with them, who are left to their own devices, and will see taxes eat away at all the growth that is being created. So certainly that is a concern, and I do think it is something investors need to be preparing for.
Yeah, and Dan, going back to your question, we know that taxes will go back up starting in 2026. But I think the question you're asking is, will legislation make that happen sooner? Right now, I'd say there's a decent chance, but of course, ask me after the midterm elections next year, okay? Because if we see some changes in Congress, or if we see a split Congress, I'll tell you, Karen, I can't believe that I pray for this, but when it comes to regulation and law changes, I pray for gridlock, because if we've got both houses controlled one by one party, that means nothing's going to change, nothing's going to happen. That's not necessarily a good thing for our country, but we know taxes probably won't go up if that were to happen. So yeah, the Democrats know they've got an extremely short window of time if they truly want to try to push through some of the president's tax proposals. So we'll see. The jury is still out on that. Well, Karen, we are out of time today. We don't want to be a burden or a pest for you today. So thank you so much for making this appearance on the Wednesday Lunchtime Drive-Thru. This has been one of our best attended one of these that we've had. I knew that it would be. A lot of people are concerned about what's going on in the market. So thank you so much.
My pleasure. Thanks for having me.
Yep. And for everybody out there, I would just remind you that you have a plan in place, whether you're part of the ChappelWood family or not. Certainly, if you're part of our family, you have a plan. And remember, your income plan is based upon higher projections for inflation than what we're seeing right now overall. Your plan is based on anywhere from 3 to 3.5% inflation, not 2.7 or 2.8. So that higher inflation is already baked in, and that's over a 30-year period. So we feel pretty good about that. The other thing that I want to remind you, of course, is to check out our new television show. If you're in the local Oklahoma City area, it airs on Sunday mornings at 11 o'clock, KWTV News 9. And it's called It's All About the Money, Honey. So thank you so much to all of you for participating in the Wednesday Lunchtime Drive-Thru. Hope you have a great rest of your day. Stay safe, and we'll see you next time. Bye-bye.